commodities are starting to outperform gold now. So gold always goes first, but then there's a certain point in time in the cycle where performance gold starts outperforming, and we're seeing exactly that. The positive thing about this brutal bear market that we saw in mining is that you now can really differentiate, and you can say, okay, those are like people that get stuff done, that can do the financing, that really deliver, and those are like the liars that will never deliver.
Well, I'm here at Resourcing Tomorrow with Ronnie Stoeferle, who I met in Zurich at the Swiss Mining Institute. Good to see you in person.
Good to see you.
How are you?
Good.
Good. I enjoyed the panel discussions, the gala and the opening panel. But just tell us briefly what you're doing here in London at this show.
Well, I'm coming here for many years now. I delivered a keynote here before. I'm on a panel in the afternoon. I'm meeting lots of companies that we're invested in, that we might invest in, that we might kick out of our portfolio. So it's always good to be here, and I think it's a lovely conference.
And what was the essence of your keynote then yesterday?
It was basically, the big long thesis that we described in this year's In Gold We Trust report, where we said, okay, now is the point in time where what we call performance gold. So this is silver, gold and silver mining stocks, but also to some degree commodities are starting to outperform gold now. So gold always goes first, but then there's a certain point in time in the cycle where performance gold starts outperforming, and we're seeing exactly that. So have a look at the silver chart, have a look at the development in the mining space, have a look at what commodities are now slowly but surely doing. I think this thesis is playing out pretty well.
So when you say performance gold, what do you mean? That's other commodities that follow gold?
So we say, okay, there's in your portfolio, we in the 2024 report was called the New Gold Playbook. We said, okay, well, the 60-40 portfolio, that's basically, that's gone. You shouldn't invest based on that rule of thumb anymore. So we came up with the new 60-40 portfolio and said you should have like 15% what we call safe haven gold. So that's physical gold stored in safe jurisdictions, shouldn't be actively timed. So it should really be like a strategic monetary insurance policy.
Like a dollar cost averaging over like a month, buy it?
No, it's basically something where I say, okay, well, ideally I'm gonna inherit it to my kids or grandchildren, but it shouldn't be actively timed,
Right.
Just
you just
hold
buy
it,
and
hold it as a strategic insurance policy.
15%.
Why 15%? We crunched the numbers. We put out a special report last year about the optimal gold allocation, and we said roughly 15% for a traditional portfolio is really like the perfect percentage. Because I know many investment banks say, well, we recommend 2% gold holding. Well, it doesn't move the needle. That's not a hedge. It doesn't have any impact on the rest of your portfolio if your thesis plays out. So we said around about 15%. But then there's also a strong case for performance gold. So performance gold, that's silver plus the gold and silver mining equities, and to some degree also commodities. But the big difference is you have to actively time it. So this is not like a buy and hold. This is not something that you inherit to your kids or grandkids. You really have to understand the cycle. You have to play the cycle. And I think now we're at the time where you should be overweight performance gold. But we all know that this bull market at some point is going to end, and you can be the best fund manager, you can be the best analyst, the best geologist, whatever, but in a brutal bear market for mining, you will still be down 60-70%. So my take is really, and that's really what we're doing in our products as well, you really have to understand the cycle, and you have to invest accordingly to the cycle. And now we're like in this be long, really on an aggressive basis, be long performance gold.
Well, timing the cycle or playing the cycle, that's got to be a skill, hasn't it? I don't know if you caught the silver panel that I hosted. So you would perhaps remember the chart that Wasif put up, the return to tangibles theory. I wonder what you make of that. So we'll put a picture of that up, but it was back in the 1970s we saw the big gold, and there's been other cycles in between. Now it's sort of the tech, and people talk about this tech boom. But he, and the way he was positioning, was very much now, this is back to tangibles. It's back to commodities. Energy is the universal currency. It's back to really that basic stuff. So you mentioned about bear markets. I don't want to be talking about them yet because obviously it will happen one day, but I've got the sense we're sort of just starting in the first innings of the commodity. A super cycle was mentioned quite a lot. So we have to be aware of how it ends, obviously, but can we be a bit more bullish at the moment?
No. I am bullish, yeah, but I think as an asset allocator, you have to also think about the downside, yeah, and you have to, actually consider the downside before you talk about the upside, yeah, and the excitement. You mentioned the term super cycle. I'm always a bit.
It's a great
every
term.
time I hear super cycle, I say, okay, well, this is usually a little bit closer to the top. But now, let's face it, from a cycle point of view, gold is in a bull market. Gold is not a contrarian asset anymore. I mean, that's crystal clear. I think, to speak in football terms, and by that I mean like real football, like soccer, we're somewhere in the second half of this game.
Right.
We can go to overtime, we can go to penalty shooting, yeah. So I think we still have like 2, 3, 4 good years ahead in this cycle. But now I think the second part of the cycle is where, again, performance gold starts outperforming. So asset allocators, they need the support from good-looking charts. So for them, it's just easier to make a decision and to make like a reasoning in their investment committees for an asset if you have a proper chart. So the larger the institution, the bigger the career risk, and the less career risk asset allocators want to do. So they usually don't act like contrarians do. So I think now we're in gold in this public participation phase. Now we're at the time where asset allocators wake up and say, okay, we need a little bit more leverage to the gold trade. Gold has already done really well. Hey, silver is basically trading at the same levels like in 2011, like in 1980. On a relative basis, it's extremely cheap versus gold. And let's have a look at mining stocks from the gold and silver space. Also, producing record amounts of free cash flow, got rid of their debt, buying back shares. So I think we're now at this stage of the cycle. And if you have a look at platinum, palladium, copper, it also seems that the commodity space in general is now breaking out. Now, where's the future demand coming from? That's the big question. 170 trillion in fixed income. And I think that more and more people are waking up saying, well, inflation isn't dead. Inflation might stage a big comeback. Many asset allocators think, well, the debt levels that we've reached, they're not sustainable. So they're getting a little bit nervous with their fixed income allocations. Yeah, and so again, it's 170 trillion. So if that's like a big pie, even if there's small crumbs from the 170 trillion fixed income pie moving into hard assets like commodities, gold, silver, perhaps also Bitcoin, that can make a big difference. And then I think the second big shift that I'm seeing is, in the general investment community, there was one really big trend, which was ESG. Right. So I said before in a meeting, I said, a couple of years ago I went to a conference and I thought, okay, I'm at the wrong venue actually, because this looks like a Greenpeace convention. So all asset managers were very sustainable and green and whatever. And I really didn't buy into that, to be honest. But that also meant that, most of them said, okay, we don't want to have anything to do with the commodity space. That's all dirty, and it destroys our ESG score. This is completely changed. So what we're seeing now is, let's say, in the broader hard assets commodity space, you're seeing really nice fundamentals where many metals are becoming strategic metals, where we're seeing much more political support, especially from the US, where we're seeing that governments are waking up, realizing, well, actually we need this stuff. We have to have a safe deliveries of commodities. We just need it for our industries. So this is a big change. Then we're seeing really nice technicals. where if you look at the charts, not only on an absolute basis but also on a relative basis, we're seeing nice breakouts. And then we're seeing that the big investment community is basically not invested at all in the commodity space. So that for me is a really good setup.
Okay.
So that's basically my big picture overview.
So at the moment then, are you sort of picking stocks? Because I think you feel that the stocks are going to start to outperform the underlying. So is this the time to be shopping? Because another sense I got was a lot of asset managers, fund managers were quite heavy in cash at the moment, probably from profit taking rather than anything else. But is that fair to say for you? You're cash heavy, you're looking for opportunities? Or?
We had in October, thank God, we were like 30-35% cash. So that was like great because we could pick up some bargains in this correction in gold. But then, I thought, to be honest, that we will see gold going sideways or slightly lower for like the next couple of weeks, even month. But then we shot above 4,000 again, and it seems that there's just so much power, so much momentum behind this move. It's really incredible, and that means that like every minor correction is being bought, and this is telling me that there's so much capital waiting on the sidelines. People that missed the gold train, that missed the gold party, they want to get in now. So usually at that time of the year, I would say it's tax loss selling season. You have to be a real genius to produce any losses in the mining space this year. So I don't think that's going to happen. But I think liquidity will dry up. Many fund managers will say, let's call it a day. Have a nice Christmas break. So I think that we can pick up some quality names at slightly lower levels because volumes will be pretty small over the next couple of weeks. But then I think everybody is hoping or waiting for the generalists to come back. We really haven't seen that yet. And if you have a look at the inflows, or rather the outflows into GDX and GDXJ, actually last year we saw net outflows, and also this year we saw net outflows despite this tremendous performance. So that's telling me, more and more hedge funds are waking up and become interested, become a little bit more activist, like we're seeing with Barrick, for example. But it's not like the big trend from generalist investors moving into the mining space yet. I hope it's going to happen. But then on the other hand, what I said at the SMI panel, that's also a message to the mining community. You have to deliver your message, your storytelling in a way that non-geologists, and I would say like 99.99999% of the population aren't geologists, and they won't understand the language that many people in the industry speak. So you really have to make it simple, provide a proper case for mining, a positive case for mining, present the numbers, and then you should be successful in gathering capital from mainstream investors. But I think that's a big to do for the industry.
Well, I know that's something that you're working on, isn't it, as well? And I think that's really important to educate investors, anyone really, about mining. You need the commodities. It's not a dirty thing that it perhaps once was or even was tarnished with. But one element that I found fascinating, and it sort of started to happen earlier this year, and it was enhanced by something that was said in Zurich, but it was this sort of idea of the crypto, you mentioned that, and the sort of Bitcoin treasuries that were coming out and all that kind of thing. And there were some mining companies in London who started a Bitcoin treasury, sort of with the thesis of hard assets meet digital assets, right? And I thought that's actually really cool, sort of marrying those two together, because there's a lot of capital, a lot of excitement in crypto, and if you can bring that with hard assets. And then something that was said on the opening panel by Garrett was about Tether Gold buying was it 1 ton a week or something? It was quite a lot of gold. And farmland, real hard assets. And then I came back, and a week later I did an interview with a tech company, a blockchain company, who's been talking to us for a long time. They've done a $200 million deal with a $2 billion fund in the resources sector, because this fund wants to tokenize the whole natural resources and mining process, from drill contracts to JORC resources, NI 4101. And again, I was just like, wow, this is maybe some of that crypto tech money is going to move over here, and that's quite exciting.
Yeah, absolutely. I mean, I can tell you, we are running our gold Bitcoin fund for almost 6 years now.
Okay.
So that's like 75% physical gold stored in Liechtenstein, 25% Bitcoin with the rebalancing. And it's got a tremendous track record, a tremendous chart, tremendous risk numbers. Then we also have one fund, which is a UCITS fund, which is 1/3 gold and gold mining companies, 1/3 silver and silver mining companies, and 1/3 Bitcoin and Bitcoin equities. We also with the rebalancing. And I can tell you that we got lots of hate from the gold community.
Sure.
Because Bitcoin is evil, Bitcoin is a scam. We got lots of hate from the Bitcoin community because gold, that's a thing of the past. I think combining both totally makes sense, especially as I've said before, where's the potential coming from? 170 trillion of investments in fixed income. I remember that in the 1970s, for fixed income funds, for bond funds, you were allowed to hold up to 40% physical gold in those funds.
Right.
In a fixed income fund. And I think we're perhaps something similar seeing happening going forward again, that there's more capital moving into that direction. Let's call it sound money. So I'm super excited about those developments, and I think it's a little bit ironic that Tether now actually using the coupons from US Treasuries, buying hard assets like farmland, Bitcoin, and physical gold. I love it. And with the Genius Act, of course, this is getting even more important. And just one last thing, the older we get, in general, the more conservative we become. We dress differently than like in our 20s. Perhaps we listen to different music. We raise families. We don't want that volatility anymore. So I see more and more, say, young people from the Bitcoin community, becoming a little bit more conservative and realizing, well, gold has done a pretty good job over the last 5,000 years. Perhaps not hold like 100% of my net wealth in Bitcoin, but diversify a little bit into gold. But then also from the gold camp, I see more and more people saying, well, actually, now that BlackRock and JP Morgan and Invesco, they're running like Bitcoin ETFs, it's becoming more institutionalized, perhaps like a small allocation in Bitcoin as well. So I like the way how it's developing, but it's been a long process.
Absolutely. Well, just your final thoughts. So I think you said earlier we're in for what, 3 years? You think 3 years? You think? I know it's hard to say these things. Could be more.
Yeah. I mean, it depends on the macro picture. Obviously. But I think we're not at this stage yet where it's getting crazy.
No.
If you compare it to a cocktail party, a couple of years ago, if you said like I like gold, people said you're crazy. I mean, gold is like a pet rock. Now it's like the stage where people say, well, gold is good. Everybody should own some gold. There will be the stage at some point where you go to the cocktail party and people will say, I just bought, I took out a mortgage and bought like a silver junior. We're not there yet.
And that's the point, isn't it?
Exactly.
Yeah, exactly. Just a final thought, and I have to ask you this: how do you pick stocks if people are looking, or is it better for them to just invest in your fund and let you do all of that?
No, I mean, I've got the majority of my wealth and my family's wealth in our stocks and in our company. So I really like what we do.
What you hold,
Lots of skin in the game. How do we pick stocks?
What are you looking for? Just some key metrics.
Well, I think when we launched our gold fund, for example, we said, well, we don't have any geologists on the team. We don't have any people that really do the mine visits and all that stuff. Our niche is to understand the cycle.
Right.
So we want to allocate our capital and our risk based on our understanding of the cycle. That's really important. And then if our signal, which is the active aurum signal, is telling us, okay, be a little bit more offensive, be like rather neutral, or be defensive, that's how we allocate our risk. So, and then when it comes to the stock selection, I'm seeing like 200 companies per year at the conferences. I'm doing lots of conference calls, permanent personal meetings, and I think the positive thing about this brutal bear market that we saw in mining is that you now can really differentiate, and you can say, okay, those are like people that get stuff done, that can do the financing, that really deliver, and those are like the liars that will never deliver. So that's, I think, really solid network that we're having, and then we're very much quant driven when it comes to our selection.
Good. Ronnie Stoeferle, thank you very much.
Thank you very much. It's been a pleasure. Thank you.